Hello, we're joined by Matt Gertken, geopolitical strategist from BCA Research, joining us from Montreal. Welcome, Matt.
Hi, welcome, James.
Matt, can you provide us with some background into what BCA Research is?
Yeah, BCA Research is the world's oldest independent investment research company. We were founded in 1949 in Montreal. We've always focused on monetary and credit cycles, in particular the debt super cycle. And that's where I really come in because the debt super cycle is a notion that policymakers, back in the 20th century were fearful of the Great Depression. They were constantly reflating the economy, and the result was a long-term buildup in debt. We now see that entering into a kind of final phase with public debt across the world reaching very enormous highs after COVID-19. And that means there's very critical policy questions, and they also ultimately impinge on the geopolitical sphere, where we see policymakers trying to avoid a relapse into great power conflict like was witnessed in the first half of the 20th century.
With those overlays of macroeconomic factors and geopolitical factors, Matt, what, in your opinion, will be the most important themes for equity markets over, say, the next 12 months?
Well, over the next 12 months, I think we'll have this dynamic where there's waning fiscal stimulus, and yet the world is still recovering from the pandemic. And in particular, the world outside of China and the US is recovering. So that's a bit of a tug of war. I think it'll be more of a slog than this rapid bounce back or snapback that we've witnessed. But it should still be positive from a cyclical point of view because, again, you've got Europe and the emerging markets finally starting to recover. And ultimately, the stimulus cliff will probably be healed. The US is likely to do even more spending after this extraordinary round of stimulus because the US will pass an infrastructure package. And I find it hard to believe that China will self-impose a recession between now and the 2022 leadership transition. So I think we will have more stimulus coming from those two as well as others. So ultimately, we may have a bridge to some further growth, but there's going to be, over the next 12 months, a lot of guessing and doubts.
Matt, pushing the time envelope out to, say, 5 years, what do you view as the biggest risk to equity markets in that time frame?
Well, for me, what is the biggest risk is China's secular slowdown. China has reached the end of the East Asia miracle economic model. And this is understood. I think most market participants witnessed, China experiencing financial turmoil in the middle of the last decade. But it's incredibly important not to underrate the combination of China going further down this inexorable path of changing the very structure of their economy to cope with higher wages and to try to shift away from manufacturing as they face international pressure. And it's international pressure that is quite extraordinary because the US now is focusing more on rebuilding its alliances, which means that there really is starting to form a global coalition putting pressure on China to change their trade practices. And so that's a negative outlook for China. And over a 5-year period, that means that the country that has provided 1/3 of global growth is going to be bringing negative surprises.
Matt, is technology now more important than the traditional manufacturing trade?
That's a tough question. I think manufacturing is making a huge comeback. First of all, fiscal policy has been rediscovered in the West. And so growth will not be as scarce in some ways when you have a proactive government with essentially debt monetization on the policy agenda. And then furthermore, you see this playing out with the rebuilding of supply chains and domestic infrastructure in the US and in Europe. Defense spending, even Japan, even Germany are starting to spend more on defense. And that points to the last leg of that, which is that there's global competition and in particular, great power struggle. And that leads countries to want to be more self-sufficient. So countries are trying to rebuild themselves. Obviously, technology is critical no matter what. But if growth becomes less scarce because of this need to provide growth and maintain social stability at home, then you're in a dynamic that's quite a bit different. There's more demand for commodities, maybe a little more inflation, And technology plays a critical role, but it doesn't play the same role that it played in the 2010s when we were in a disinflationary context.
It's a fascinating perspective. This has been In Brief. Thank you for joining us, Matt.
Thank you.